Assalamualaikum warahmatullahi wabarakatuh. Nama dia Marzia Hasni. So today our group will be presenting about financial analysis and scenario-based decision making for our main company, which is Bonia, and its competitors, which is Padini. In the next page, we have our group members, which is me, Nurul Izzati Fatini binti Othman, Nurul Fatiha binti Nur Amran, Nur Alia Suhana binti Shameli, Siti Zulaika binti Salehuddin, and Nur Hamizah binti Roslan.
I will present the company background of Bonia Corporation Berhad. Bonia was established in 1974 and has grown into one of Asian leading luxury fashion retailers. The company specializes in the design, manufacturing, marketing, distribution, and retail of premium leather goods, footwear, apparel, handbag, accessories, watches, and lifestyle products under brands such as Bonia, Brown Buffalo, Carlorino, Sembonia, Valentino Rudy, and Santa Barbara Polo. Its mission is to design and produce an innovative portfolio of timeless products that enrich lifestyle across generations. Bonia's objective is to strengthen its position as a leading luxury fashion retailer by delivering high-quality products, enhancing customer satisfaction, expanding its regional presence, and creating sustainable value for shareholders. The company background of Padini Holdings Berhad. Padini was established in 1971 and has grown into one of Malaysia's leading fashion retail companies. The company specializes in the design, manufacturing, merchandising, distribution, and retail of apparel, footwear, accessories, and lifestyle products under well-known brands such as FIN534, PDI, Mickey, and brands outlets. Its mission is to provide fashionable, high-quality, and value-for-money products while delivering excellent customer service and creating value for stakeholders. Padini's objective is to strengthen its position as a leading fashion retailer by offering quality, affordable products, expanding its retail and online presence, enhancing customer satisfaction, and achieving sustainable business growth. Thank you.
So moving on for the financial statement analysis. For this presentation, I will revert the financial statement comparison between Bonia and Padini Berhad over the 3 years period, which is 2023 to 2025. This analysis evaluates 4 core financial metrics, which is revenue, net income, total asset, and also total liabilities. So moving for the revenue, looking for the first at the revenue trend, both company recorded positive sales performance throughout that 3-year period. However, Padini consistently generates sustainability higher revenue than Bonia, demonstrating a stronger market position and dominating sales performance. Additionally, while Padini achieved business growth, Bonia maintains stable sales performance but faced slightly downward trend during this period, widening the market share gap between two competitors. Moving on to net income, both companies managed to remain profitable. Nevertheless, Padini consistently recorded a significant higher at net income compared to Bonia, reflecting superior cost management and operational efficiency in converting revenue into profit. In contrast, while Bonia stayed in positive territory, it experienced a sharply declined earnings trend by 2025, which is underscore an area for operational improvement. So next is for total asset and total liabilities. In terms of total asset and total liabilities, the balance sheet structure reveal different corporate strategies. Padini maintained a stronger asset base, which equip them with greater investment capacity and long-term resource to support future expansion. In other hand, Bonia carried a higher proportion of liabilities relative to its business size, indicating a heavier reliance on external financing. Overall, Padini achieved a healthier balance between its asset and obligation, resulting in stronger financial stability and lower solvency risk.
Next, I will present the profitability ratio analysis for Bonia and Padini from 2023 to 2025. Firstly, Bonia consistently recorded a higher gross profit ratio than Padini, although it declined slightly from 61.50% in 2023 to 59.22% in 2025. In comparison, Padini maintained a lower gross profit ratio, ranging between 36.23% and 39.39%. This indicates that Bonia earned a higher gross profit from its sales due to its premium pricing strategy. Secondly, Bonia maintained a positive operating profit ratio, improving from 1.92% in 2024 to 2.92% in 2025, while Padini recorded a negative operating profit ratios throughout the 3 years. This suggests that Bonia managed its operating expenses more effectively than Padini. For the net profit ratio, Bonia experienced a significant decline from 24.13% in 2023 to 3.48% in 2025, while Padini also declined from 12.22% to 7.99%. Although both companies became less profitable, Bonia decrease was much more substantial. Looking at the return on assets, Padini consistently outperformed Bonia, recording 10.79% in 2025, compared with Bonia 1.12%. Similarly, for the return on equity, Padini achieved 18.24% in 2024, whereas Bonia recorded only 1.65%, showing that Padini generated better returns from its assets and shareholder equity. In conclusion, although Bonia maintained stronger gross profit margins, Padini demonstrated better overall efficiency in generating returns. Therefore, Bonia should focus on improving cost management and operational efficiency to enhance its future profitability.
So, my name is Alia, and now I will present the liquidity ratio analysis of Bonia and Padini from 2033 to 2035. For Bonia, the company maintained a good liquidity position throughout the 3 years. The current ratio increased from 2.8 times in 2023 to 3.35 times in 2025, showing an improvement in its ability to meet short-term obligations. The quick ratio also increased from 1.9 times to 2.13 times, while the cash ratio remains stable at around 1 time during the period. For Padini, all liquidity ratios remain strong and consistently higher than Bonia. The current ratio remains above 4 times throughout the 3 years. In addition, the quick ratio stay above 2.7 times, while the cash ratio remains strong at above 2 times throughout the period. Looking at the trend, Bonia showed gradual improvement in its liquidity ratio, while Padini maintained consistently strong liquidity performance over the 3 years. When comparing both companies, Padini performed better than Bonia in all liquidity ratios, indicating a stronger ability to meet short-term obligations. So, in conclusion, both companies had healthy liquidity position and were able to meet their short-term obligations. However, Padini demonstrates stronger liquidity performance and better short-term financial stability compared to Bonia.
Thank you, Alia, for presenting liquidity analysis. I'm Izati, and now I'm going to continue with the efficiency analysis. So, Bonia's efficiency ratio analysis from 2023 to 2025 highlights a decline in operational performance and resource utilization. Accounts receivable turnover decreased from 7.69 times to 7.28 times, reflecting a slower customer payments and less effective receivables management. Inventory turnover also fell from 1.75 times in 2023 to 1.61 times in 2025, suggesting slower stock movement movement and potential inventory accumulation. In addition, fixed asset turnover and total asset turnover decreased from 2.94 times to 2.32 times and 0.61 times to 0.55 times respectively, indicating reduced ability to generate sales from its asset base. These efficiency issues are consistent with the financial statements, where revenue declined from RM 424 million in 2023 to RM 377 million in 2025, reflecting weaker sales performance during the period. Meanwhile, for Padini's efficiency ratio analysis from 2023 to 2025 shows a strong working capital management despite a decline in asset utilization efficiency. Accounts receivable turnover improved from 27.63 times in 2023 to 32.08 times in 2025, indicating faster customer collection and effective credit management. Inventory turnover remained efficient, increasing from 2.55 times in 2023 to 3.06 times in 2025, despite peaking at 4.25 times in 2024, showing effective inventory control. However, fixed asset turnover and total asset turnover declined from 21.13 times to 12.14 times and 1.09 times to 0.94 times respectively, suggesting that the increase in asset base was not fully supported by revenue growth, resulting in lower asset efficiency. Overall, Padini demonstrated better efficiency performance compared to Bonia throughout the analysis period. Padini recorded a higher inventory turnover of 3.06 times compared to Bonia's, which is 1.61 times, showing stronger inventory movement. In terms of asset utilization, Padini achieved a higher total asset turnover of 0.94 times compared to Bonia's, which is 0.55 times, indicating a greater ability to generate sales from its asset. Therefore, Padini maintained stronger operational efficiency than Bonia, although both companies experienced a decline in asset utilization over the 3 years period.
So next is the solvency ratio for Padini and Bonia Company from 2033 to 2035. So for Bonia, the debt ratio has decreased from 34.35% in 2023 to 32.35% in 2025, showing that the company has relied less on the debt financing. And the debt to equity ratio also declined while the equity ratio has remained stable. In addition, the long-term debt to equity ratio has decreased, indicating a lower long-term financial risk. However, the time interest earn ratio dropped significantly from 12.11 to 2.24, suggesting that Bonia's ability to cover its interest expenses have weakened. Meanwhile, for the Padini's company, they show a complete opposite trend, because the debt ratio has increased from 37.57% to 42.24%, and the debt to equity ratio also rise from 60.19% to 73.12%, indicating a greater reliance on debt financing. At the same time, the equity ratio also declined, while the long-term debt to equity ratio has increased, showing a higher long-term burden. However, the times interest earn ratio also decreased from 13.61 to 7.21, but it still remains higher than Bonia's, indicating that Padini still has a stronger ability to meet the interest obligation. In overall, Bonia has a more conservative capital structure with lower debt, while Padini carries a higher debt but still maintain the strongest interest coverage.
Next, I will explain the scenario analysis. The purpose of this analysis is to compare each scenario with the original financial performance and see how change in revenue and operating expenses affect the company profitability. For scenario 1, EBIT increased for RM 173.97 million to RM 193.975 million, an increase of 11.49%. Net income also increased from RM 164.57 million to RM 184.57 million, or 12.15%. This happened because revenue increased, although higher operating expenses reduced part of the additional profit. For scenario 2, the result were much better, which is EBIT increased to RM 253.534 million, which is 45.73% higher than the original. Net income also increased to RM244.12 million, an increase of 48.34%. This is because revenue increased while operating expenses decreased. So overall, scenario to give the best financial performance because the company earned higher sales and control its operating expenses more effectively. This show that increasing revenue together with good cost control can significantly improve the company profitability.
To conclude, our financial analysis showed that Padini has performed better overall than Bonia, especially in terms of efficiency, profitability, and also in asset utilization. Meanwhile, on the other hand, Bonia has experienced an declining revenue, profitability, and also in operational efficiency, indicating challenges in generating higher returns from its resources. The scenario analysis also has demonstrated that changes in sales and operating expenses have a significant impact on EBIT, tax expenses, and net income. Therefore, effective cost control and revenue management are essential for improving financial performance. So, in overall, Padini has a stronger and more stable financial position, while Bonia should focus more on improving its operational efficiency, sales performance, and also profitability to achieve a long-term growth. So, I think that's all from our group, and thank you.